Hello, hello again, friends, traders, investors, stock market fans, participants. How are you guys doing today? It's great to see you. My name is Jason Krutzky. It's a pleasure to be with you today. It is FOMC day, and many are saying that this is probably the most important one that we've had yet, really since they started raising rates. If anybody was able to tune into our spaces last night, we got to have a really nice conversation with a bunch of TrendSpider friends. And it seemed pretty unanimous. You know, everybody kind of seemed a little nervous. Everybody seemed a little bit unsure about what was going to happen. Most of our guests were going to be sitting on the sidelines for this thing and going to let it play out. I kind of feel the same way. I'm a little concerned and a little unsure, and I'm excited to be here with you guys today to watch it all go down. So that's really why we're here. We're going to watch as the market reacts to the initial announcement, and that's in about 29 minutes. And then about an hour from now, we're going to have Jerome Powell talk. You can see I've got it preloaded up here above my head. And we'll just hang out and hear what he has to say. I also have a lesson for you guys. I want to walk you through building out a scanner idea that I came up with, or that I thought might be relevant, apropos, is that the right word, for the time and place right now. So please do, if you are planning on hanging out for a little while, get comfortable. Get yourself your afternoon coffee, or, you know, get your lunch or what have you. And let's just hang out. There's a bunch of you guys here. I would love to have you guys say hello. Nobody has said hello in chat. Please say hello. Let me know your name. Let me know where you're tuning in from. Let me know what you're thinking about how this is going to play out today. I want to take a little bit of time and go through the charts. What's up, ZLV? How's it going? Spring in Prague. Nice. I love Prague. It is absolutely one of my favorite cities in the world that I've been to, at least. Beautiful place. What's up, Robert Brush? How are you, man? Great to see you. I hope you're well today. How are you guys positioned? Actually, hold on one second. I just noticed that you can hardly see me, so I'm going to turn my lights on real quick. That's a little better. Yeah, how are you guys doing today? How are you positioned? What are you thinking? What's your plan? Are there any stocks that you guys are watching? What's up, Paul Brown from St. Paul? How are you, buddy? Hope you're well. What's up, Alex? How are you? What's up, Greg from Virginia? Great to see you. Thank you guys for tuning in here. Any big expectations for today? Do you have anything you're planning? What's up, Joe T from Phoenix, Arizona? Nice. Great to see you guys. Yeah, I am your long NVDA. All right, Robert, let's go. That thing has been an absolute monster lately. What you got targets on it? What are you kind of thinking there? I have been, ever since the earnings, the gap up on earnings, I've been kind of keeping my eye up in here. So I actually am taking the other side of your trade, Robert. I have to admit. It's not a huge position, but I am short a little bit of NVDA. I know it's dangerous to do here. You don't want to short the most powerful thing in the market. But it's just right at a spot that I feel like should get a little bit of a reaction. But we'll see. I could be totally wrong. Why not? Hello from Cali. What's up? Robert, this is what makes a market. My short is going to make your long work better if it goes against me. Right? Isn't that the case? Noah, what up, bro? Good to see you, man. Happy you're here. How's Arizona looking today? Is it balmy and beautiful? Julian, bonjour from Paris. Thank you for being here, Julian. I also am a fan of Paris. I've only been there one time, but it was a lovely short jaunt to Paris. No rainy. Oh, bummer. Well, you know, the desert needs rain, right? Rain is good. Paul Brown, you think that the Fed will back off a little to collect more data points. So when you say back off, are you anticipating that they're not going to raise it all today? There was some stats. Let me grab this. Need to think of where they are. We had my buddy Rahul, who hosts a ton of Twitter Spaces. He came on as a guest last night, and the reason why I was really excited to talk to him is because he talks to like some really, really smart people, and I just wanted to like get his thoughts on what those really smart people were kind of expecting. But he sent me this. This was the bank's expectations. Actually, let me pull it up right here so you guys can kind of see this too. Bank expectations, Bank of America, 25 bips hike. Barclays, Deutsche, all say 25 bips hike. JP, Morgan Stanley says 25 bips hike. Goldman says a pause. Wells Fargo says a pause. And then Nomura says a cut. So that's kind of interesting. Nomura, the black sheep of the family there. But Paul, you say no rate increase. You know, the collective mind, from what I can gather via Twitter, via news sources and such. What's up, Naresh? Hope you're well. Via different news sources that I'm following, pretty much everybody says that not raising rates would be bad news. Pretty much everybody. They say that it would be the Fed clearly maybe knows a little bit more about what's going on with the banks than we realize that they know or than they're saying. And by changing their stance, inflation is still hot. So by changing their stance and choosing to not raise rates here, it would be a bad look. Julian, I don't think you're the only one that thinks they'll increase the rates. Well, I guess it depends on what you're thinking. Are you thinking they're going to do 50? Because pretty much the group think is a 25 bips hike. Naresh, within Fed members alone, there's a lot of conflict. Interesting. Jay Powell has messed up and will make up for it in his language. Being hawkish and raising 25 bips. It's certainly possible. And that is the sentiment, right? From pretty much everybody that I've talked to and pretty much everything that I'm reading is that nobody cares what the bips hike is. Ultimately, it's about what Jerome Powell says and how he says it, right? 25 bips in soft language. What does soft language mean? Sounds like a band name. Seems like Fed is in rock and a hard place. They keep raising rates, put regional banks at risk. Not raising equals possible trouble. Yeah, agree with you, Joe. It's hard to know. It's really hard to know. And this is why I feel really uneasy here. In times previous, I kind of didn't care, I guess. Kind of knew what things were going to be, right? You kind of expected stuff, but now it seems like a big question mark hanging over the markets here. I mean, let's talk about like where we're at. Just looking at the indices, and we can look at individual names if you guys want to, but on the indices, I mean, obviously Q's looking really good, right? Nice bounce off the 200-day moving average last week and really the past couple of weeks, but it's been holding nicely. This is the anchored VWAP from year to date. So this is just from January 3rd, coinciding with the 200-day. If we zoom out to the weekly here, you guys know we love our anchored VWAPs. It's just one of the best indicators. On the anchored VWAP side, from the COVID lows, notice what we're doing here. First time we've really tried to do this in some time. This anchored VWAP from the COVID low has been really, really difficult to get up and over the past weeks, over the past like 6 weeks or so. We've traded through it quite a bit. If you guys can hear my dog barking in the background, I apologize. I don't know what she's barking at. She's a little barky today. But we're trying to do it again here, right? And you've got to figure after like enough times banging your head against this thing, a push through might be imminent here. We did hold lows, right? Back in December, we held higher lows. We made a new high. We potentially held a higher low here. Trying to go for another one, trying to go and grab this high and take it out. Maybe they're targeting up here somewhere, 323, somewhere these old highs, something like that. But all in all, pretty darn constructive, right? I mean, fibs from the high, see what those look like. 50% retrace has already been tested once. So that's something. You could do an anchored VWAP from the high, and we're coming right into it. This could be a decent place to test it. You can see we've come into it quite a few times over the past year and a half. Haven't quite been able to get up and over it since, what is this? This is December 2021. So that might be a spot to be watching if you're still long biased here. On the SPY, things don't look quite as good as the Qs, but they don't look terrible either. Same deal. Let me remove, yeah, here's your anchored VWAP from your COVID low. I know I've got a lot of anchored VWAPs going here. I've got my year-to-date one, which is what we're toying with right here. You get your anchored VWAP from the highs, coming right up into play at some point, potentially here soon. You've got your anchored VWAP from COVID low. Perfect support last week. Where are we at on the daily? I'm gonna remove this guy here. Up and over the 200-day moving average, up and over the year-to-date anchored VWAP as well. Might be trying to come into this previous high. They did hold the December lows, just like the Qs. So constructive, right? Not terrible. IWM, not nearly as good of a look on the daily. Here's your 200. Here's your anchored VWAP from year to date. And we're still holding those December lows. They were not able to break those December lows. That's really important, right? As far as trend is concerned. You're making higher highs, higher lows. You want to continue to hold lows. Whether or not this is going to hold on, we do not know. But it's something to be mindful of. Zooming out to the weekly, your anchored VWAP from the COVID low. Now that is a problem, right? Quite below it here. It's at 187. If this thing does rally and is able to move back higher, we're definitely going to be watching both that year to date, that 200-week moving average, that anchor view up from the COVID low. Those are all going to be spots that are going to be maybe pretty difficult to get through. Rubber brush. Soft language is not hawkish language. Traders will shrug off this Fed nonsense anyway. You think so? They've been nothing but dysfunctional all along. Supply chain was the real issue, and they have ignored it. DRI reports tomorrow morning. DRI. Don't know anything about DRI. What's DRI? Darden. Yeah, I don't know too much about this one, my friend. But it looks pretty darn good, doesn't it? Kind of found support at, what is this, like Q3 2018 highs, where they gained, but they kind of failed. They didn't really gain it. So when they did finally gain it, they came back in and tested it here. Really nice. And up and over these closes too. Highs and lows are important, but the closes are kind of more important to me. So being up and over these closes seems like a pretty big deal. Specifically this one from your all-time high quarter. Yeah, interesting. Definitely relative strength here, right? I mean, damn near all-time highs. That's pretty crazy. They own Olive Garden, Longhorn Steakhouse, Yard House. Ah, gotcha. SPY will and should make up for February redness by going green in March. Possible, yeah. Wish, China stimulus for Wish. Let's see. Oh, bro, come on. What is this? All right. How long have you been trading, Alan? The only reason I ask is this looks like a really lousy ticker to be trying to... It looks like a really lousy ticker to be trying to take a position in. This looks bad. So I don't know. Sure, maybe they have some China stimulus coming their way. But when a chart looks like this, I never look at it again. I'm not going to lie. There are so many tickers out there to trade, you know? That's how I feel about it. There's so many tickers out there to trade. Why on earth would you want to trade this one? I love Roku. Naresh loves Roku. This one looks pretty bad too. I mean, Anchor View app from the yearly start. It is holding that. Give them 3 months. I mean, sure, man, maybe so. They're back up and over 200-day moving average. Something that we have not seen since, what is this, August of 2021? Alan's in everything. NVIDIA, SPY, Meta, Tesla, Apple, Target, Hershey's. Covering all the bases. Okay, right on, Alan. Right on. As long as you're making a, you know, you're sized appropriately. Just stocks that look like Wish tend not to ever look better. Yes, you know, there will always be opportunities for short squeezes and things like that, you know, depending on maybe they do some sort of big reverse split or something. And then a couple of chat rooms get a hold of it and pump it to, you know, 500%. It'll happen again, I'm sure. It's just the question is, does it happen after they reverse split 2 more times or what? Let's see here. Pravin loves Microsoft. Well, hold on. Let's look at you real quick. I kind of like Roku better than you, man. You just have to assume that they're going to be stuck in this for like ages. This giant range. But I mean, I guess if you can play the low end of the range and take it to the top end of the range, that's good. My thoughts on Microsoft. It's being a laggard today, isn't it? And just generally speaking, I guess this is what I had drawn up on my chart. Up and over the 200, up and over the year-to-date anchored VWAP. Where are you at on fibs? Interesting. Check that out. Coming right into that 50% retrace from high to low 2 days ago, 3 days ago. And rejecting. And you have that broadening range too. Whenever I see a broadening range, I'm always looking at RSI. I'm looking for divergence. You know, you're making new highs, higher highs with RSI not making higher highs. So you made a new high here. RSI 69. Yeah, I don't know. 70. Yeah, you did kind of make a slightly new high on RSI. I know that Microsoft is kind of in the laggard relative to some of its counterparts. Buying at the top of the range scares the crap out of me personally. So I wouldn't want to do this. This to me seems like more of a short opportunity than a long opportunity. It doesn't mean that they can't continue gaining. But that's how I would kind of look at it. I would much rather be buying somewhere down in here. What's a weekly look like? Weekly held a higher low, made a new high, held a higher low, made a new high. The trend is sound. You do have this gap right here. Did they fill it? No. So that would be interesting for them to come in and fill this gap. Take out these highs. You got to assume there's probably some sellers up here. I don't know if there will be, but you know, kind of safe to assume. Wish is planning a 30-for-1 or a 20-for-1 reverse. Yeah, see? There you go. You didn't have to tell me, and I knew. BNFD? Oh, BNED. Interesting. Looks like I've looked at this. Barnes & Noble. I like the store. I don't like the chart. But you're holding a higher low. Technically speaking, what's the deal with all the volume last week? God, this thing's trading $1.74. Yikes. What's the deal with all this? Is this like earnings? Yes. Earnings. Lousy. I don't know, man. I don't know. Again, I posed the question, why would you trade something that looks like this if you could trade something that looks so much better than this? If you're trying to go long, that is. Is our software similar to TradingView? Well, yeah, I would say so. I mean, it's a, charting software. We have different goals though. Our goal is to make it so that you can do everything you would want to do on the technical analysis side inside of the platform. From, of course, marking up your charts to alerting to scanning to strategy testing to turning those strategy tests into proper orders via our product signal stack. Tapped a banker to handle their 2024 debt. Man, you know more about this than I do. If there's a reason, if there's a reason to be bullish here, go for it. Just know where your risk off is, know where you want to be getting out of this idea. Like for me, a new low relative to this 158 low. If you go and you make a new low relative to this, that's not good. The fact that they're holding lows, that's good. They bounced, they came right up into your daily pivot, or rather daily gap here. They filled the gap. They immediately sold it off. This is kind of crazy though. This move is pretty nuts off of the earnings. I guess the day after earnings. What's up, Bradley? Everybody shout out Bradley. We're big fans of Bread911, one of the best traders out there in the FinTwits. If you don't already follow him, definitely give him a follow. He doesn't post many charts these days, but when he posts a chart, it's worth paying attention to, I must say. Credit where credit is due. We are 9 minutes away from this announcement, and I've got a handful of charts pre-set up for our viewing pleasure. I've got the Qs, the SPY, the IWM, the XLF. Up here, I've got gold, I've got Bitcoin, I've got Ethereum, I've got VIXI, I've got NVDA, I've got Apple, Tesla, and I got 5 more spots. And I'm only doing these names because these are names that are pretty common. Whenever I do these shows, I always offer to watch whatever names you guys want to watch. So you tell me, what are you thinking? What tickers do you want to watch that are not here already? And also be considerate of the fact, we got NVDA, we've got Apple, we've got Tesla. They're going to move relatively similarly, right? So maybe other sectors or other kind of totally different tickers. I've got the 1 minute time frame on so that we can see like exactly what's going on. GME. Yeah, that's a good idea. We'll put GME up because GME's been ripping. Looks like I had a level drawn there at some point. Let me go to a different time frame. Kind of want to see what's going on at GME because I've seen people talking about it, but I haven't been paying any attention. They got up and over a 24 level. I guess I had that as an important level. Those previous highs, February 6th. Interesting. Oh, and previous lows too, huh? Got it. So like the support resistance flip, Jake talks a lot about these, these big areas. Support resistance flip looks like it's trying to hold it right here. Interesting. Oops, no, I didn't want to take a picture of this. Close that out. Have you guys, while we're waiting for the announcement, have you guys discovered some of the new features? All right, so DXY we cannot do, but we can do UUP, baby. Let's do UUP here. FDX, let's do that. I like that idea. I feel like snow is too adjacent to like all the other tech. Let's do crude. Do you have one in particular? A particular ticker? You want to do like CL? TLT? All right, we are filled up here. Can everybody kind of see everything? Oh, well, I get that UUP, actually UUP is being completely covered up by me. I'm going to put UUP here. And then I'm going to, instead of Apple, I'm going to do FDX. Because we've got NVDA, we've got Qs. So we got a pretty decent list. And then you guys don't have to worry about what's behind me. Tight. We got a good little group here. So while we're waiting, like I said, we got what? Just a couple minutes left. Have you guys seen some of the new things? Obviously, the big one right here. Our sidebar. You can now easily turn it on, turn it off, add widgets with one click very easily. This is nice. This is a request that we've been getting a lot lately. So it's awesome to be able to add this. We turn this back on, notice some changes in seasonality, just the colors of the bars. That's pretty. A nice little pretty change there for seasonality. And then on the chart pattern side, did you guys notice? We've got rising and falling wedge auto chart pattern discovery now. What's up, Nigel Whitehead? How you doing? Naresh, I do not have the put call ratio chart, unfortunately. I don't think I do, unless there's like a particular ticker. So rising and falling wedge auto discovery now. Pretty sweet. You can scan for this stuff now too. You can scan for these chart patterns. Pretty cool. Craigslist? I'm not sure what you mean. Is Craigslist a publicly traded company? Easy way to do supply demand. I mean, in my opinion, I'm going to go back here. In my opinion, your best case for supply demand is volume by price. Let me see if I have it up here. Yeah. There's a couple of different tools you can use, but volume by price is a good one. You can drag it to any point on the chart and it's going to measure the amount of volume at every single price point from where you've got it anchored forward. So pretty easy to see where all the volume is based on wherever you're anchoring from. That's one way that I would do this. Another way is the heat map. And specifically, I'm into the horizontal heat maps because they look for consolidation. They look for price making the same highs and lows over a period of candles, and then they plot the consolidation out. It's like perfectly clean little head and shoulders thing on the Qs. Lovely. Maximum pain and options volume numbers. We do not model world. On a scale of 1 to 10, how reliable is rising and falling wedges? Ooh, I don't know. That's a very good question. I don't have an answer to it though. I think the big key with any pattern is let it prove itself. So if you see a rising or a falling wedge and price breaks out, then you would want to see it come back and test and hold the level that it broke out from. Well, what you're asking for is something like you'd have to back test it, right? And there is not a way to back test it to know exactly how often they work. My guess is probably a 50-50 shot. I would say that, it's to some degree, it's like self-fulfilling prophecy, right? If enough traders are looking at a thing and that thing fails, price breaks up or breaks down, you come back in. If enough traders are looking at it, you're probably going to get a bounce at the level. But then it's all about time frames too, How long do you want to be in the trade for? Indicator settings back tested. Can you give me a bit more specificity on exactly what you're looking for there, Model World? You can definitely back test indicators. You can use our strategy tester to test all kinds of indicator conditions. I'm actually going to kind of walk you through how that works. Potentially while we wait for Jerome, but also potentially after Jerome. I'm not sure yet. If there's time, I'm going to do it while we're waiting for Jerome. If there isn't, then I will do it after Jerome speaks. But I do want to walk through. A strategy test, a very specific strategy test, and then I'm going to, or rather, a very specific scan. I'll share that scan with you guys at the end, and then you can take that scan and do different things with it. What is the most reliable pattern based on my experience? I actually really like broadening ranges. I like to trade broadening ranges personally. But again, That's a pattern I like to trade. That may not be a pattern that other traders like to trade. And it may work very well for me and not well for others, right? It's all so unique in that way. All right, so we're moving here. I reckon the number is out. Dollar is dumping. Gold moving. QQQ moving. SPY moving. IWM moving. Raises by 25 bips. All right, 25 bips raise. And the market is pleased. I'm going to keep on adjusting here. VIX is failing. ETH is gaining. Bitcoin is gaining. Gold is gaining. The dollar is dumping. Crude is gaining. Treasury's gaining. Okay, first time you're happy with a raise. It has to be done. It has to be done. Inflation's still insane. They have to raise rates. Model world. You can absolutely utilize the strategy tester to test all kinds of RSI, MACD, stochastic conditions, sir. Yes. What's up, Lori? Our book winner, one of our book winners. Congratulations to Lori. She won the Alpha Trends Maximum Gains. What's the name? I can't remember the name of the book, but very much congratulations. Greg, yes, 25 bips hike. They raised by 25 bips. I'm so stoked for you, Lori. I'm sure it's a great book. I have not yet read it. I have his other one, and it's awesome. But I have not yet read the new Maximum Gains with Anchored VWAP, I believe is what it's called. Something like that. Brian's a brilliant man, and he's a lovely dude too. He lives 30 minutes south of me. So on occasion, every once in a while, me and him and Jake get to hang out. TLT selling off here. Qs giving back the initial little move. Gold staying strong. Bitcoin selling off. All right. It definitely seems like, and I could be wrong here, but it definitely seems like the consensus was it's all about what Jerome says. Gold still bidding. Crude made a new very, very short-term high. It's all going to come down to Jerome. 27 minutes until we get Jerome. I will be broadcasting his talk, and I will be muting myself. As soon as he is live, it will be in the screen above me. So we will get to hear it straight out of the horse's mouth, the proverbial horse's mouth, how we're feeling about these things. Sometimes it's not even about what he says during his, because he'll come up, right, and he'll do his little speech, and then it's all about the questions. Once people start hitting him with questions, and he's got to answer these things, that's when the things get real. Ha, Lori. That's why we're here. We're watching. Nobody has any idea what's going to happen to the market later. If we knew that, none of us would be here. We'd be sitting on a boat. Sitting on a boat, fishing. Enjoying the cool breeze, perhaps. Or on a beach somewhere. Somewhere tropical. You see where my head's at? It's snowing at my house right now. So I'm thinking about summertime. It was 65 degrees here yesterday, and now it's snowing. It's like, what's going on? All right, everything has regained its initial move. So it looks like that was just a nice little back test of the initial move. At least on the indices, IWM continuing higher, XLF continuing higher, VIXY continuing lower. Crude looks like it's continuing higher as well. TLT looking like might be trying to make a new low. We'll see. UUP continuing its move lower. Excuse me. Microsoft going back to 282. It's very possible. Let's pop over there real quick and look at it. Yeah, definitely could, man. Definitely could. What's up with NVDA? 274? That doesn't fare well for me, Robert Brush. But congratulations to you, sir. Actually, hold on. Let me go back to NVDA here. I'm going to put this on the daily. I want to see where we are relative to this high. 279. That'd be another spot I'd be watching. Just right up into these highs here. 282, 279, somewhere thereabouts. AMD cracked 100. Let's see that, yes. Looks like I had some levels. It's through all of them. Super strong. Looks like it's trying to go for these highs. That would be kind of wild. Take out the lows and take out the highs. Interesting, interesting. $110 next week for AMD? I don't know. Depends on what Jerome says. There are not many people that are calling for wildly higher here, but I will say there's one gentleman who is like screaming for a melt up. Michael Guyette. I don't know if any of you guys follow him. He was supposed to come on our spaces last night and he bailed on us, and that's a bummer. But I wanted to talk to him about that because he's very strongly opinionated about this. He says melt up coming. And I wanted to ask him where he got his conviction from. But he didn't show up, so I couldn't ask him. All right, so what do you guys think? We've got 22 minutes until Jerome gets here. We could do one of two things. We could just continue hanging out, watching the charts. Or I can take the next 10, 15 minutes or so and walk you guys through how to utilize the scanner and some multi-conditional stuff. You say hang out, Naresh? You don't want to learn? That's fine. I'm happy to hang out. I still want to teach you guys something. And I can do it after Jerome too. Lori says the scanner. So I'm going to wait. I'm going to do 5 votes on either side. We got 1 for hangout, 1 for scanner. First 1 to 5 wins. Scanner. Scanner. All right, we got 3 for scanner. Naresh wants to learn now. Naresh, you said hang out, but now you want to learn. Okay. We can hang out and learn at the same time. Pravin says scanner. Jerry says scanner. Greg says scanner. All right, y'all, we're going to do some scanning. All right, so the thing that I wanted, or the thing that I kind of prepared for you guys today, obviously banks are top of mind, right? Everybody's talking about banks. And what I was kind of thinking about sharing with y'all was this idea of bottom feeding, how to find bottom feeding opportunities. The banks are going to be what I'm going to use to work off of. So in a way, I'm going to kind of curve fit my idea to what's going on with the banks right now. And I want to like make sure that you guys understand that I am kind of curve fitting based off of current conditions. So take what I'm going to teach you guys, and then you can apply it. And again, like I said, for all of the TrendSpider users in here, I'm going to share this with y'all when I'm done. I just want to walk through all of the individual pieces of the idea that I had. So the first thing we got to do, we got to go to the market scanner. Now let's talk through what I mean by bottom feeding. Well, what I mean by bottom feeding is a stock that has sold off pretty dramatically and is maybe starting to turn, right? So there's a lot of different ways that you can define sold off dramatically. But to me, the most obvious, easy way to do it is with price. So we would want to first define what's going on with price, right? We would want to say that the price now is less than the price was a certain number of candles ago and by a certain amount, by X percent. So that's the first thing we're going to define. Again, like I said, I'm going to curve fit this for banks. So we're going to say condition, we're going to say price, we're going to say close, or rather daily. Close is less than price, daily close, X candles ago. Now, the banks, everything happened with the banks, what, like 8, 9, 10 days ago, 10 sessions ago, something like that? Oh, it is, isn't it? Oh, let me do this. Good. Man. Okay, so I'm going to do this for a moment. Yeah, okay, so now you guys can see it. Good thinking, Pravin. Thank you for the heads up on that. So the first thing we got, price close, less than price close. So we're talking about today's close is less than a candle close in the past. And we want to take into account, because we're talking about banks here, we want to take into account a close before all of the bad news. So I'm going to say 15 candles ago, because that gets us, like if I go to JPM here, and I look back 15 candles, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, right? That gets us back to before the shit hit the fan, the proverbial shit hit the fan. And then the next thing that I want to do is I want to define how much it's closed lower than, right? By at least by a percentage. You could define this as 3%. You could define it as 7%. You could define it as 10%. You could define it as whatever percent you want. Make it whatever makes sense to you. If you're looking for a bottom feeding type of opportunity, maybe a 10% sell-off is what you're after. Maybe a 5% sell-off is what you're after. Maybe a 3% sell-off is what you're after. There's not a rule here. Do whatever you want. I'm going to say 7, not 107. I'm going to say 7. So the price closed today, which is essentially the current price, is 7% less than the close 15 candles ago before everything went down. The next thing that we have to do is we want to define the low, right? We are trading, for the most part, we're trading above where we were trading when the banks hit lows right now, right? So we want to define that. We want to say that the current price is greater than the most recent low, right? And I'm going to use an indicator called range to define that, quote, most recent low. So I'm going to say price close. Actually, I'm going to say daily price low. I'm going to say low is greater than indicator, daily range, low, right? And in here, I can define the amount of candles I'm referring to. Since I'm looking back 15, I don't need more than that. So I can say 15, right? So it's taking into account 15 candles, and it's looking at the lowest low of the last 15 candles. And you're just saying that today's low is greater than that. The other thing that we need to do, we don't want today's price to be lumped into this calculation of the range. So we want to offset this range by one candle so that today's low is unique And the range low, the range that we're talking about is yesterday's candle and back 15. So that's why we offset it. So that's the first piece of this, right? And what I'm going to do is I'm going to go to banks here. I'm going to my scan through list, say major banks. I'm going to say current candle on because I'm looking for all this to be true right now. And then I'm going to scan. So now we got a bunch, actually. We got a bunch of tickers meeting this criteria. A bunch of these random banks. A lot of them I'm not even familiar with, but there are, big names on this list as well. So the next thing that we might want to do is we might want to explain to we might want to filter this out to some degree. And you could start with these filtering conditions. You can end with these filtering conditions. There are no rules about how to add filtering conditions, but I always add something. So in this particular case, since I have a bunch of tickers that I'm not familiar with, I want to whittle this down to maybe the best ones. Maybe, and how I define the best is relative, but I'm going to define the best as the ones that are most traded. So the ones that have the most volume on average per day, right? Or have at least a minimum amount of volume on average per day. So that's the next thing I'm going to define. I'm going to say that on average per day, the tickers that show up in this list that are meeting this criteria also have to trade at least 500,000 shares a day. It's just a minimum that I'm defining to whittle down results. Because when you're scanning, right, you want to whittle down the results as much as possible so that you get the most accurate results, right? Yeah, BAC is a case in point for sure. BAC, JPM, Citi, and so on. Wells Fargo, whatever. So let's add that. We're going to say condition. We're going to use indicator. We're going to say daily volume. And we're going to use the volume, comma, MA, because it's a moving average. We're going to say greater than a constant value. And we're going to define 500,000, right? So on average, 500,000 shares a day traded. Now, there's something to think about here too. We just had a ton of volume on most of these banks over the past 7 days. Have we not? And will that not also then skew our volume moving average? Yes, it will. So by default, our moving average is set to a 20-period SMA. So it's looking at 20 days worth of volume, adding them all up, dividing by 20, and getting our average. Well, that number is very skewed now because of all the volume that came in last week. So we want to unskew that by making this moving average length longer, right? That flattens out our line a little bit. So we're going to do that. We don't necessarily have to do that in every case, but if you're looking to add a condition like this to an idea like this, it makes a lot of sense to do it so that the data isn't skewed, right? Does that make sense? Hopefully that makes sense. So we rerun the scan and we're going to get a smaller list. It's still a pretty big list, but it's a smaller one. It's more manageable. And that's really important. We want it to be more manageable, right? The next thing that we want to do here is we want to define at least one thing that I look for, and different traders can look for different things for different reasons. One way that I use to find bottoming opportunities is I use RSI divergence. You can use other types of divergence if you'd like. I like to use RSI divergence. So I specifically like to define price relative to the current price relative to a different price, a different day's price. And then I want to see the divergence in RSI. So in a bottoming opportunity, I might want to look for instances where maybe today's price is lower than a couple days ago, but RSI is increasing, right? Does that make sense? Hopefully, I think I have to assume that at least some of you guys are pretty familiar with divergence. So divergence being the opposite thing. So we need to define that, right? We need to define RSI is increasing while price is decreasing. So how do we do it? Well, we do it with two conditions. We say indicator, we say daily, RSI, right, is greater than indicator, daily, RSI. And then we have to define the candles that we're referring to. Now, in some cases, this is going to be, we're going to whittle out results. The whole idea here, right, we're continuing to try and whittle out results. So we want to make sure that, well, how to best to say this. This is going to vary, right? Again, like I said, I'm kind of curve fitting here, and I just want to talk you guys through all these different parameters so that you understand the idea. But do understand that I'm curve fitting in the sense that I'm trying to get very specific results here. So anyway, all that to say, I want to define that RSI is increasing, price is decreasing, and over the same candle. So I'm just going to use something random. I'm going to say RSI. I don't know. I'm going to say RSI 5 candles ago is greater than RSI 7 candles ago. So it's increased. And I'm also going to say then that price, we could use close, we could use low. It might make sense to use low. Price low is less than price low. And then we want to say, price low 5 candles ago is less than price low 7 candles ago, right? Because we're specifically defining RSI has increased at the same time as price has decreased, right? And I'm just using, like I say, random numbers here. But again, I'm just trying to get you guys to think about how this all plays, right? So if we throw up RSI, you look back 5 candles, you've got a low 5 candles ago, which is lower than the low 7 candles ago. You can make it 8, you can make it 6, whatever. But you've got RSI increasing over that time. You've made new lows, your RSI has increased while you've made the new lows, right? Does that kind of make sense? Hopefully that makes some sense. And again, I want to reiterate, I know I've said it like 100 times, but I want to reiterate, I'm kind of curve fitting here. This move has already kind of started bottoming, already started forming. So if you were thinking about looking for this in the near term, you're looking for something that the move hasn't like started happening. Maybe you've got that divergence, or the divergence is very, very early in forming. Maybe what you want to do instead of 5 and 7, maybe you want to say, you know, RSI today on the current candle, so 0, is greater than RSI 2 candles ago. And maybe you want to say the low today is greater than the low 5 candles, or is less than the low 5 candles ago, or the less than the low 2 candles ago, or whatever, you know. The whole idea here is just trying to help you guys think through how to kind of start building a bottom feeding type scan like this. So that's it. That's what I got. Does anybody have any questions about that? Did that all make sense to y'all? And did you understand like why I chose the indicators that I chose, why I chose the parameters that I chose, kind of the filtering devices that I used? You could filter it even more by like price, for example. You could say price close greater than X just to remove everything that's trading below a certain price from the list of results. What I'm going to do, I'm going to share this guy with y'all. So for all of my TrendSpider users out there, here's the scan that we just built. If you click on this, it's going to take you to a page. It's going to take you to a page that looks like this. Just click login and import and then subscribe, and then you'll have it. And you can play with it from there. And like really think about all the different ways you could utilize this, right? This could be more than just some big time frame type of thing. Like I use the daily in this case, but what if you use like a 15-minute time frame, and instead of a 7% move down, what if you use like a 0.5% move down or a 1% move down? You know, thinking like more day trading opportunities, that sort of thing. The idea is to get you guys thinking about how to utilize the tool. And then really from here, you know, you could go and you could back test it. You could use the strategy tester to test this and see how it performs on these names. Yeah, how's everything looking now? All right, so the Q's made a new high. Everything made new highs And now they're selling off back to where they started from. We've got Jerome Powell coming up here very shortly. Now, I will say with this, you guys, for anybody who has joined me for one of these spaces before, you know that when Jerome Powell starts talking, sometimes this particular webpage that I'm on is late to the gun. If you happen to notice that he is live, you know what I also can do? Excuse me, youtube.com/Federal Reserve. Okay, we'll keep an eye here too. I think I'm going to watch this from YouTube. I think it's a better bet. So what are we doing, guys? Are we sitting on our hands here? Seems like the initial sugar rush has already worn off. Lori's sitting on her hands. Wisdom. I believe that's a wise thing to do. You guys, it is snowing out here. I'm really anxious to hear what he has to say. Because he's started in the past couple of things I've seen him talking on, whether it be like interviews. Can we look at EMPH? Sure, Austin. Okay, so let me just remove my stuff. You have and on there? What EH? I'm confused. What are you saying, man? What are you thinking about EMPH, Austin? Where's your head at on this bad boy? Higher highs, potentially higher lows on the monthly. You got a bit of a broadening range thing going on here. On the weekly. Looks like they're just trying pretty desperately to hold this stuff in here. These highs that they were kind of having trouble getting through. In this like 180, 200 range. Trying to hold it. They did make a new weekly low last week. And then they're coming back in to test kind of where that low took us. Right here. Now, some would look at this and say this is a double top, right? Actually, I'd be curious to know. We have, let's see if our double top finds it. Yeah, so there you go. Auto double top detection. So the idea behind this, the idea behind double tops is you really want to see this level in between them hold. When you break down below that level, that's no bueno. Killed by autocorrect. So this is the level that I would be watching personally. If you're long, that 234 spot is pretty important. You could see how they tried to bounce it. They lost it. Then they rejected it quite a few times before continuing to go lower. But I don't know, man. I guess it just depends on your idea. It depends on your time frame and all that sort of stuff. I would definitely be looking for longs down here at 120 if it got there. I can tell you that. Might even look a little bit higher, actually. 160. Kind of at this previous pivot low. Somewhere down in here. Would expect them to hold that if they... because they did make new highs. All right. Our man's up. Let me turn this on. Let me turn my music down. And let me turn this up. All right, guys, if you're going to trade this, good luck to you. Be safe out there. Don't do anything crazy. Good luck, Jerome.
Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings in the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year.
Order filled.
In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories.
Stop filled.
Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high.
Order
The
filled.
median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment
Stop
and stable
filled.
prices
Stop
for the
filled.
American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine
Order
the
filled.
extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate.
Interesting.
We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation.
Order
Our
filled.
policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be
Stop
5.1%
filled.
at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting
Order
factors.
filled.
These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the
Order
last week.
rejected.
And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision.
Order filled.
Okay, just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that.
Order
Of course,
filled.
it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes maybe, some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
Order filled.
Mr. Chairman, can you explain the difference between ongoing rate increases and firming? Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly were, what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy may have less work to do. We simply don't know.
Do you have concerns that the hike you did today could further exacerbate the problem in the banks?
No, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular our lending facilities, the discount window, and also the new facility.
Nick Timmeros of the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and, the people who write the minutes will be very carefully counting. But I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would
Stop
really have
field.
the same effects as our policies do. And that therefore they were including that in their assessment, and that if that turned out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SEP forecasts. I think there may also just have been. Remember, this is 12 days ago. We're trying to assess something that just is so recent, and it's people. It's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first part, the first 5 weeks of the intermeeting period, pointed to stronger inflation and stronger labor market. So that pointed to higher rates, and then this latter part, kind of the possibility of credit conditions tightening, really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system, open market account, as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
We know that we have other tools in effect, but no, we think our monetary policy tool works, and we think many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask, you, along with the FDIC and the Treasury, the Fed Board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation? So
Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized right away that there was going to be a need for a review. I mean, the question we were all asking ourselves that first weekend was, how did this happen? And what we did was early Monday morning we sat down and said, let's do this, and he was obviously going to lead it in his capacity. So I don't, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Howard.
Hi, Chair Powell. Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes. I mean, what actually happened, Howard, was I got the question 12
Order
times.
filled.
Maybe it's a feature, not a bug. But yeah, absolutely absolutely the same. The story is intact. So it's really three parts, right? Goods inflation's been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February, and we still don't have now, is a sign of progress in the non-housing services sector, and that is, that's just something that will have to come through softening demand, and perhaps some softening in labor market conditions. We don't see that yet, and that's of course 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue. And we don't really see it yet. It's so people are making estimates, people are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Gina?
Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank, and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management
Order filled.
failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, in a very, very fast run, faster than the historical record would suggest. So as for us, so for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week. So, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear, to your last question, it's clear that we do need to strengthen supervision and regulation. And I assume that there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
Sorry, and the final point, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously, they were on this issue, but nonetheless, this still happened. And so that's really the nature of the review, is to discover that.
Go to Mike McKee.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every
Order
meeting
filled.
the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening of credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Let's go to Rachel Siegel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next, and that smaller regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we're well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is strong, it is sound, it is resilient, it's well capitalized, and I really don't see that as at all analogous to this.
One other question, would you be open to an independent investigation separate from the Fed's probe?
I welcome. It's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome, when a bank fails, there are investigations, and of course, we welcome that.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky, so do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things, and we have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So we will get inflation down to 2% in time.
And if I can follow on that, but they're working, the spending that's happened is working against what you are doing, right? So it's prolonging inflation?
If you have to look at the impulse from spending, because spending was, of course, tremendously high during the pandemic, and then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning, perhaps, part of what was driving inflation, but that's not really the story now.
Let's go to Neil Irwin.
Hi, Chair Powell. Neil Irwin with Axios. Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago. First, why is this new bank funding facility
Order filled.
Done under emergency 13.3 authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss
Order
the Fed's
filled.
role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
Sure. So 13.3 seemed like the right, we have a little more flexibility under Section 13.3. We've done quite a lot under the discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements, but it seemed to be the right place. So with the FDIC, we're lending to in effect, we're
Order filled.
lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
Chris Rugaber.
Thank you. Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end? Thank you.
Absolutely not. No, if we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is. And we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So people think of QE and QT in different ways, so let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Hi, Chair. Katerina Saraiva with Bloomberg News. The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's been quite an interesting 7 weeks, but I will tell you though that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as it is now on the public record, the supervisory team was apparently very much engaged with the bank repeatedly and was escalating, but nonetheless what happened. And so that's really the purpose of one way to think about the review that Vice Chair Barr is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the of the run, it's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. Yeah, I don't know.
Simon Urbanovich with The Economist. Thank you very much. Chair Powell, you've stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors? Thanks.
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Go to Greg Robb.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
Sure. So, that was really the Swiss government. We, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been, the markets have accepted it, and it seems to have gone well, and I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well so far.
Nicole.
Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market, and it's a highly uncertain estimate, and I mean, there's really we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, as I'm sure you have, you can see that if the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
But I guess the question is, historically, it's hard to...
Mr. Mike, please.
Yes, sir. Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections and your thoughts?
Well, it depends on whether so recessions tend to be nonlinear, and so they're very hard to model. The models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, we're very focused on getting inflation down, and because we know in the longer run that is the thing that will most benefit the people we serve. That's how we can have we've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation, and we had several of those, and they're very good for people. You see late in expansion, you see low unemployment, you see the benefits of wages going to people at the lower end of the wage spectrum. It's just a place that we should try to get back to.
Jean. Hi, Chair Powell. Jean Young with Market News. I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
You know, it's too early to say really whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that. You know, the question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines in or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and you know, we're certainly trying to find it.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate attention citations at this point?
How many? I don't know. But those are serious regulatory, particularly immediate attention. That's and I guess there were 6 of them. So.
And getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
That is a great question and is right in the heart of what the review will be doing under Vice Chair Barr's leadership. So I think that's what you think about. You know, what can we do to make sure? But again, that's not for me to answer today.
So you have specific thoughts on that?
Well, I see. If I did, I wouldn't share them because I really, you know, this review's going on, and you know, I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. You know, it just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, you know, to this work, not connected to this bank, and under again Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Curious how you view financial conditions now, and if credit were
okay.
to tighten enough, if that would prompt a rate cut.
So financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, you know, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, you know, what will be the extent of it, and what will be the duration of it, and then, you know, once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, you know, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, you know, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, and you know, so that's all I have to say. So, thank you very much.
Well, there it is. What do we think, y'all? All right, Sonia, have a good one. One man wrecking crew. Yeah, I don't know. That was an interesting presser for sure. How are you guys feeling? Are you feeling good about it? Feeling not so good about it? Ooh, let me turn this down. Much better. Well, guys, I am gonna make my way out of here shortly. Does anybody have any last minute questions for me before I get out of here? Yeah, Noah, I'm with you, buddy. I don't really know what to think either. It does seem a little, he was kind of wishy-washy, right? He kind of said they're going to pivot. They're not going to do any more rate hikes. And then he kind of said, we'll do them if we have to. Robert, this is what you were asking for. You just wanted him to shut up. GME to the moon. Yeah, maybe so. Turn this off. What was I trading? I was trading futures. Doing okay. I'm surprised you could hear that. No path to lower inflation. SDW is putting all of their money in Starbucks gift cards. All right, Noah, great to see you, man. I got to get down to Arizona and play some golf with you guys. But always a pleasure, man. Hope you're well. All right, Brian, you take care. I'm going to get out of here too. You guys got that scan for me. Let me hook you guys up real quick. Where am I looking here? I don't know if anybody took advantage of the St. Paddy's Day sale that we had going on last week, but if you did not, and you are still interested in becoming a TrendSpider user, here's a 35% discount for you that you can utilize. It's been a pleasure hanging out with you guys. I will be live again briefly for like a short period of time tomorrow. I'll be doing like pre-market pulse show. So just kind of answering questions. If you have any questions about the platform or anything like that, you're welcome to tune in and hang out with me while I am answering those questions. Ask away. I'm happy to help you guys out however I can. Robert, Lori, I'm going to be live tomorrow at 9 a.m. Eastern time. So it's usually about an hour. I usually hang out for about an hour. So no agenda for those. I don't have anything in particular to teach you guys. I'm just hanging out, looking at markets, answering any questions that come along. So if you got them, feel free to come hang. If you don't, that's okay too. All right, y'all. Well, it's been a pleasure. Be safe out there if you're trading the rest of the day. I hope nothing but green trades for everybody. I hope you guys all kick ass today. And again, thank you so much for being here. I really do appreciate it. You guys make this job super fun for me. And I'm always thankful. So yeah, have a great rest of your day, and we will see you guys soon. Enjoy that scanner. Play around with it. If you find anything awesome, hit me up. Let me know. My Twitter handle is @KrutzkyTrades. It's written right on the little panel over here. Feel free to give me a follow. My DMs stay open. If you have any questions at any point about TrendSpider or anything else, hit me up. I'm happy to help. So have a good rest of your day, and we'll see you all very soon. Bye-bye.